When most people hire a financial planner, they think they are paying for performance or some kind of specialized knowledge about which way the market is moving next. They're looking for the person who can get them into the next big tech run, like Nvidia, before everyone else figures it out. And I understand why that's the case, because the financial industry used to hold access to information that most consumers can't get unless they work with an advisor. But the time is different today. And with the rise of discount brokerages like Wealthsimple, Questrade, and robo-advisors, everyone has access to almost any market you want to invest in with a few clicks of a button. I'm Jim Pan, an advice-only certified financial planner and the founder of Panorama Financial Planning here in Vancouver. And the reality is that the thing most people think they're paying for is the one thing the industry can't consistently deliver. The research is not even close on this, as the vast majority of actively managed funds underperform a basic index funds over the long run. And yet we still see people handing over 1 or 2% of their entire portfolio every single year, hoping this time will be different. The real value of a great financial planner has almost nothing to do with getting the highest rate of return. The actual value comes from 3 completely different places that most people didn't know about. They are: number 1, I call it the circuit breaker. Number 2, the Lego strategy. And number 3, the clear game plan. Before we get into those, we have to acknowledge that money is just a tool. And we often talk about maximizing RRSPs and TFSAs like they are the goal, when they are really just buckets to help you reach something else. Your actual goal is likely freedom, like being able to say no to a project that's draining you, or being able to say yes to 3 weeks in Japan with your family without feeling you're overspending. I care way more about why you want to retire at 55 instead of 62 than I do about the decimal points on your rate of return. Because if the numbers don't serve the life you are trying to build, then the numbers are essentially useless. There's a significant amount of research from places like Vanguard and Morningstar that asked what a genuinely good advisor is actually worth. And they all land in a similar spot, which is roughly 3% per year in additional wealth. I want to be very clear that this does not mean beating the index by 3%, because that is almost impossible to do over 30 years. But rather, that 3% comes from 3 undervalued supports that have everything to do with behavior and structure. The circuit breaker accounts for nearly 2% of that on its own, and the remaining 1% or so comes from intelligent structure and having a clear game plan working together. And I'll show you exactly what I mean by each of those. The first support from a financial planner is what I call the circuit breaker. Believe it or not, the single biggest threat to your wealth isn't the stock market. It's actually the human behind the investments. And the data on this is sobering. Delbar, a research firm that has been tracking investor behavior since 1985, found that the average equity investor has underperformed the market every single year for the past 15 years. And in some years, the gap has been enormous. In 2024 alone, while the market returned around 25%, the average investor took home just under 17%, a gap of nearly 9% in that single year. That gap has nothing to do with picking bad stocks. It comes entirely from bad timing, buying after market have already run up and selling after they've already dropped, and doing it repeatedly over a lifetime of investing. Over a 30-year window, the average investor ended up with around $800,000 from a starting point where the index itself would have returned over $2 million with the same starting point. That's not a small rounding error. It's a completely different retirement. Vanguard calls this the behavioral coaching opportunity, and their advisors' alpha research estimates that helping clients manage their emotions during market volatility can contribute up to 2% in additional net returns annually. which is why it accounts for the largest single piece of that 3% figure I mentioned earlier. We have a natural tendency to want to buy when things feel safe and prices are high, or to bail when things get scary, and often that's when prices are lower. And having someone to call when you are about to make that emotionally driven decision is the single most valuable thing a planner does. I think of it like hiking a ridge in the Rockies when a storm rolls in fast, where you don't need a geology lesson about the rocks. You just need someone to grab your shoulder and tell you that, hey, we've seen this before, and the best move is to stay the course. The second undervalued support is about intelligent structuring, or what I call the Lego strategy. Most people treat their finances like a bunch of completely separate pieces, like a TFSA over here and a corporate account over there, and maybe an old lira from a previous employer that's just sitting there collecting dust, like the old golf clubs you've been meaning to sell. The reality is that having all these pieces together isn't the same as having a plan. And just by putting the right investments in the right account, like maximizing your registered accounts before non-registered accounts, or choosing low turnover ETFs or corporate class funds for your corporate investments and non-registered account, you can add a significant amount of wealth over time. Here's a simple example of what getting this wrong actually looks like. Say you hold a broad market ETF that pays a regular distribution inside your non-registered account, and you also have RRSP room sitting unused. Every distribution that lands in that non-registered account is taxable income in the year you receive it. But if that same ETF were sitting inside your RRSP instead, that distribution compounds untouched until you actually need the money. Over a 20 or 30 year window, the difference in after-tax wealth from that one decision alone can be tens of thousands of dollars. And most people have never been told to think about it that way. Then we have the silent killer, which is tax drag. The CRA is essentially your biggest uninvited business partner, and they are actively taking a piece of your T4 income and your corporate dividends if you aren't being intentional about it. Here's what I mean by that. If you hold a dividend-paying ETF inside your corporation or a non-registered account, every distribution that lands in that account is a taxable event. And at the top marginal rate most of my clients are paying, they're heading back over 50% on every dollar of income before that money even has a chance to compound. And that's just the income piece. If you are actively trading, or if you are in a fund with high internal turnovers, which simply means the fund manager trades a lot in the portfolio, those realized capital gains are being triggered every year, whether you ask for them or not. And every time that happens, the compounding clock gets reset on that portion of your money. The math on this is brutal over a long time horizon. A lot of smart DIY investors I see are great at picking investments, but very few are optimizing for tax efficiency across a 30-year window. Let me give you a rough sense of scale. If you have a $200,000 non-registered portfolio earning 7% annually, the difference between a tax-efficient structure and an inefficient one, think high turnover funds versus a low turnover index ETF with proper allocation, can conservatively be $50,000 to $100,000 over 30 years. And that's before you layer in the corporate account dynamics that most incorporated professionals are dealing with. The difference between paying attention to that and ignoring it is often the difference between a vacation property and a very large, completely involuntary donation to the government. The third undervalued support is what I call the clear game plan. It's about having someone who holds your full financial picture together and keeps you accountable to it. And the research on what that actually does to your life is worth talking about directly. FP Canada surveys 2,000 Canadians earlier this year, and the numbers are striking. Half of all Canadians have lost sleep because of financial worries. But among those who work with a financial planner, that number drops to 28%. Money is the number one stressor in people's lives by a wide margin, more than twice as stressful as the next thing on the list. And people without a financial planner are nearly twice as likely to say their money is the biggest source of stress. And when it comes to optimism, 2/3 of people working with a planner feel hopeful about their financial future compared to only half of those going it alone. Vanguard looked at this from a different angle and surveyed over 12,000 investors. And the finding that stood out to me was about time. 3 in 4 advised clients reporting saving around 2 hours a week on their finances, which adds up to over 100 hours a year. When Vanguard asked what people did with that time, the top answers were leisure, time with family, and exercise. I often wonder what you would actually do with 100 hours. For me, it's like playing 25 more rounds of golf or actually being able to do things I like with my family. And that is the real ROI you can't put on a statement. But everyone who has experienced it will tell you it's worth every single dollar. And there's a third study that makes this point better than I ever could on my own. The Financial Planning Standard Board surveyed over 15,000 consumers globally and measured something most investment statements would never show you. They scored things like quality of life, financial confidence, and life satisfaction on a scale from 0 to 100. And people working with a CFP professional scored higher across every single category, not by a small margin, but by a meaningful one. The people with a plan felt better about their health, their sense of purpose, their ability to hit their financial goals, and their overall satisfaction with life. You can't put that on a pie chart, but it's the shift almost everyone who has gone through a real planning process will tell you was the biggest one. The truth is the traditional model often works against you on all 3 of these. Because when an advisor is paid based on the size of your portfolio, they aren't always incentivized to tell you to pay down debt or fix a corporate structure that's bleeding money. I'm advice only, which means I don't sell products or earn commissions. And my only job is to make sure your corporation and your investments and your family goals are all moving in the same direction. If this resonates with you, the link in the description is a good place to start. I'll see you in the next one.